July 2nd, it has been just a slow grind, but steady to the upside all day. Market gap lower, lows around 61.88, melted up all morning about 40 points. So we're sitting near the highs at 62.23. Let's see where the close is in this final hour. Up to some fresh highs on the year. Not a bad P&L for the day. I'll certainly take it. Hitting some resistance levels. I'm watching the 62.20. Took profit earlier in the morning with some indecision. Actually, it was a combo trade. So we had daily profit play, took some profit in here, took some profit with price getting outside of my box as well as staying inside. So we tried to play the market both directionally and non-directionally, and we're fortunate to get paid on both. If I was still holding the non-directional, it would be worth a little bit more, but I ended up taking a nice chunk out of it anyway. So goal was hit. I'm going to set a take profit here. Let me see if we can get back down to like 62.15 maybe, or 62.10, just to see if we stay below some of the deltas here. Melt up today. Let me look at the lows. So I was expecting maybe like a 1% move from low to high, only about 0.6%. So still like pretty quiet overall. 0.6% is decent. Market average is like 0.4, 0.45. So we'll see if we fade a couple of points with some near-term resistance around 62.25. We did have a pretty sticky level at 6,200 today, but once the market got through it, it was just gravitating towards 62.20. So that was a bit of a directional play. Let's see if we get down below 62.20 by the close. Again, it's been up all day. We've actually been closing. I'm not going to say like negatively. We've just been closing with some red towards the end of the day. So does that happen today, or is this like a big run up? We're going to sit at these highs waiting for non-farm payroll tomorrow. Eric says the market does not stop. Where do you see a pullback coming? Eric, that has been the question for literally the last month. I mean, since we got to all-time highs, I thought the market would maybe hesitate a little bit. This first week of July usually is not a bearish month or a bearish week. It's usually quite bullish as we go into a holiday trade. So path of least resistance is up, as we've been seeing, as we've been watching. The markets use some, pretty intense catalyst to just drive the markets up. I mean, the biggest thrust that we've seen to the upside have been a ceasefire in the Middle East and U.S.-China trade agreement gap. Right? Like that all happened. That was really the big pushes that the market just said, hey, things are okay. Let's just keep grinding higher. There really hasn't been a thrust. That was the two catalysts here in the last, like, I'd say 60 days that have propelled the markets up to all-time highs and then some. To me, the pullback is going to happen with some type of disappointing earnings season, which we start kicking off earnings in the next few weeks. If we go to, we have inflation data coming in the next 2 weeks. So not next week, but the week after, we'll have another round of CPI and PPI data. I know the Atlanta Fed had like a higher headline inflation reading. They were looking at like a 2.6. The previous inflation reading was, let me go to, let's go inflation data, CPI. So we've been trending higher in inflation. Here is the news. So our headline CPI year over year is 2.4%. So are we going to project higher? Are we expecting higher? I mean, like I said, Atlanta Fed showing like 2.6 is the expected headline inflation. That would be, again, trend in the wrong direction. But if we go back a little bit further, we go back like 5 years when all this is really relevant. We peaked out here in 2022. 3% was kind of the sigh of relief in the market. Inflation's coming down, right? But then it's been sticky and sideways ever since. So 3% up to 3.7, down to 2.4, up to 2.9, back down to 2.3. So is this going to be the sign of inflation where we're just doing this up to down, up to down, up to down, up to? Do we get back below 2%? Maybe. I don't know. Part of me thinks with a tax bill getting passed through, it's probably higher for inflation. Trade war, thought it was going to be higher for inflation, but to be determined. I think we still have to watch and pay attention to what the bond market's going to do. What the bond market's going to do, what the bond yields are going to do, but that really isn't relevant until probably September, because that's when the Fed policy is going to change. If the Fed cuts rates, what do the bond yields do? So I think the only real catalyst right now would be earnings. If we have poor earnings, if being the big question, if we have poor earnings, then sure, we could see the market correct because earnings aren't great. But I would say optimism is pretty high right now. The environment seems to be like pro-business. We've got some deregulation. This is no longer like a trade war scare. This is more like what's the U.S. trying to do to navigate this trade war situation. And if earnings are at least hitting expectations, maybe they're not awesome. Maybe they're not perfect, but they're good enough to at least keep the market steady, right? We may not thrust the market significantly higher, but it could be enough to see just more of the melt up. The S&P has been rallying nicely. The Nasdaq's been rallying nicely. Tech's come back in a pretty big way. You got a lot of pushes in the stock chips, the chip stocks rather, the semiconductors, the software space, the tech space. Not all stocks traded equal, but certainly the gains we've seen since April on a lot of stocks have been pretty interesting. I'm going to look. Actually, let me do a search here. I'm going to go Copilot. Let me see if I can find something here. What are the best performing stocks with percent returns since April 7, 2025? Let's see what the best performing stocks are. You've got to be kidding me. According to StatMuse, CVS Health, there's got to be more. Best perform 49.6%. Come on. Like since April 7th, there's no way. They've got to be better. Let me see. Give me the best performers in the S&P, Dow, Russell 2000, Nasdaq 100. Best performers and percent gains from April 7, 2025 to, we'll go to June 30th. That's a little bit better. Okay, top performing stocks by index April 7th. Let me see what this shows. So show the SP full list. Take me to the list. Palantir up 80.7%, NRG 77.1, HWM 70.6, STX, GEV, big list of stocks here. Year-to-date returns. Okay. I mean, you can search it, but I'll give you the top 20. Top 20. I'm going to type it in here in Telegram. Top 20 S&P performers. So I'll go top year to date. Top 20 year to date S&P stock performance. I'm just going to take a screenshot so I don't have to type it all out. I'm going to go top 20. You'll see some household names. You've probably heard of them. You've probably traded them. Seagate Technology, STX, Palantir, Energy, Newmont, Supermicro, Howmet Aerospace, Mosaic, Uber, GE, Dollar General, CVS Health, Philip Morris, Ultra has been great, GE Aerospace, KLA, Western Digital, Micron Technology, CrowdStrike, Netflix, Coinbase. Top 20. There you go. Microsoft announces more layoffs. Yep, I saw that this morning. They're announcing like a layoff of like 4% of the global workforce. Alpha says, any possible to exit more? I mean, you can exit now. I mean, if you're still hanging on to it, you're down $3, right? I mean, you collected it. If you did the trade out of this morning, it was $1.95. It should be trading for like $3 and change right now because it's 62.23 is cash settles in the next 45 minutes. All we have to see price do is, again, this is like all or nothing, right? At this point in the day, we either go higher or we have a rejection. So if we are less than 62.20, then we keep the full amount. So if you're still in the trade for $1.95, if we're less than 62.20, then this thing cash settles for the full profit at 195. Okay, but obviously we have to have in the next 45 minutes, we need to have price at least come down a little bit. So if not, then it can cash settle at 62.23. I'll be down $300. I did take in a $1.95 credit, so the net loss would be about $100. Okay, so I mean, honestly, like if you're still in the trade, I want to see where the thing settles. I want to see if we get below 62.20 by close. This is a pretty big resistance level between 62.20, 25. If we have just a little bit of a pullback here versus just like literally melting up all day. But obviously the market does what the market wants. So if you don't like it, you can bail on it, take the loss. But if it does come down another $2 and $3 to below 62.20, there's a chance you can still grab a profit at the end of the day. Okay, all right, let's go top down. I was looking at some trades. I was on the profit panel this morning at 11 a.m. I did take a trade on Micron that got posted in my Project Options Edge. I looked at a trade on Snowflake, but I couldn't get the fill, so I put in a pending order at $1.50. I was looking at like a 115 by 110. $1.50 credit hasn't been filled yet. I'm going to wait on that one. Let's go tail of the tape this morning. We are sitting here going into a holiday week. Market has had, I mean, look at these green candles, by the way. 1, 2, 3, 4, 5, 6, 7, 8. We have 7 candles out of 8 bullish. 7 candles out of 8 bullish. I mean, it's just like this. Market's up, pulls back. Market's up, pulls back. Market's up, probably pull back. I just don't know to what degree. Maybe pull back here to all-time highs and that's it. Is it pull back into filling some, ceasefire gapping? I mean, I don't know the why. That's what's so silly. It's like, why would the market pull back there? I mean, a variety of reasons I can say and think of, but it's like they've not worked. All these reasons to be bearish have not worked, right? So all I'm doing is I'm hedging very cheap and watching those hedges be worthless. But meanwhile, I am up. I mean, today's like a pretty good day. I mean, I'm up 24K. This is fresh highs by a decent chunk. It was, hanging out at like 300,000, 301, 302. Today I got a pretty nice surge up here, 322K. So that's my new high for the year. And hopefully there'll be more. Hopefully this is, getting up to 350 and 375. And I mean, I'd like to try to push for 500K this year. That'd be pretty sweet. But to be determined. Got to make sure I'm managing risk. Okay. So, I mean, we definitely have a run up into this little holiday weekend. Tomorrow is going to be interesting because we have, we're squeezing in non-farm payroll in the morning at 8:30 a.m. So here's the news tomorrow. Non-farm, 8:30 a.m. Markets close by 1 p.m. Trading is going to stop. There'll be some Forex markets probably open through Friday. It's just going to be very low. Again, what are the numbers? Forecast for the jobs, 111. Previous was 139. I would expect to see a revision of some sort. Average hourly earnings, let's see what happens. Unemployment rate, we have gone from as low as 4%, steadily up 4.1, 4.2, 4.2, 4.2, forecasted for a little bit higher unemployment of 4.3. Again, historically, it's still pretty low. And jobs numbers have been steady around that like 100,000 plus, and we've had positive job prints for X amount of, I want to say years now. I can't think of the last time. Let's try to go back and see. When's the last time we had a negative job print? The last time we had a negative job print would have been 2021. 2021. That's the last time we had a negative non-farm number. So, obviously a lot of this is under Biden and there's questions to how many jobs are actually created. But we are seeing steady decreases in non-farm. From 200,000, now we're down into the 100s, 114, 142, 12K, just by the skinny of the zero line, 12K, with a revision from, 254 down to 223. And then we had a positive revision from 12K to 36K. The 227 beat, the 256 beat, the 169 came in less, the 159 came in less, 228, 177, 139. This is forecasted for 111. I think we can all see that there are jobs that are not coming back. Tech especially is not hiring. Mag 7 is not hiring. The AI play it's a threat. It's just nobody really knows how bad it gets and how quickly it comes. I do think that this AI play could be a hype and a bubble that provide so much ridiculous runs and gains and profit margins that you'd be silly to try to fade this market. If you think about it, like think about what is this market built on? It's built on companies making more money. If the companies can make more money, make more profits, it should help shareholders. It should gain in value. Well, if we're about to fire millions and millions of workers because they're going to be displaced from the workforce, we're going to have a ton of shareholder value. To what degree, I don't know. Was the market going to run to just bubble-like territory before it crashes, and all of a sudden it's a reality check? Like, hey, we don't have any workers anymore. I mean, it's like nobody knows when this is happening. I don't think the world is ready for it. I don't think that governments are ready for it. I don't think that people are ready for it. But there's going to be a lot of value and a lot of profit margins and a lot of gain and a lot of hype and a lot of optimism that's built into this, because corporate profits wise, AI is a good thing. And it's happening whether you like it or not. So yeah, it's the whole storyline. It's the whole narrative for 2025. And this is what the growth is. If you're going to grow your way out and grow your way and have, positive GDP and positive growth and positive profits, it's going to have to be from something that you can do way more with less. And that is AI, right? Like that's it. So anyway, we'll see how it all shakes out. But I am so tired of just trying to sit here and call tops that I'm not doing it. So what I'm looking for is, okay, if we have a dip, pull back to a ceasefire gap. Cool. I can position from there. If this dip pulls back a little bit more, we pull back into this US-China trade agreement gap, fine. I mean, that would be a meaningful pullback to still be positioning for maybe trying to get to the highs again, or maybe try to get up to higher highs. My least favorite trade would be that this keeps going and going and going and going and going and going and going. That'd be my least favorite trade. It can certainly happen, but it's my least favorite trade. I do have a couple positions in here. We talked about it in my waterfall income class. This is a call condor. So price is here. I have a profit trap, and then I have some risk. Okay. We have about an 80% chance of profit on the trade. If we have any type of volatility or increase in the VIX, I think that's going to happen more to the downside. So that should help increase that probability of profit. But it's way up here towards 65.35 and 66.40 over the August and September levels. I'm trying to go out far enough. Okay. Let me get a couple of questions here. MP says, saw your income math and had a quick question. What happens if you buy 100 shares Intel, your example 22.91, then it drops for whatever reason? Yep. And that's why the trade that I always consider is, if I wanted to protect the downside, is a collar trade. So would you like to spend a little bit of time on that? Let me bring up so we talked about this yesterday. Okay. This is my simple math income trading, just covered calls. If you are worried about the downside, okay, if you're worried about the downside, then here's what you do. It's a collar trade. So this is one of my favorite trades for core positions. So collar trade is an options combo that sells a call, at or above price for credit, and buy put at or below price for debit. Okay. There's two ways to look at it. A collar trade for a credit, or the collar trade for a small debit. Okay. And what you're doing is you're essentially doing this. You're accomplishing two things. One is price can stay the same or go up, and I can make money. Price can go down, and I have a long put hedge to help lower my cost. Okay, so let's take this simple math like I talked about yesterday. Where'd it go? Here. So let's take the simple math I talked about yesterday and add a collar trade, or look at a collar trade. Okay, so here's what it looks like. If I go to the options chain on Intel, we talked about buying the shares at, it was like 22.90 was the example yesterday. Let's just look at it from scratch. So we can buy the shares roughly at $22. Okay, so here's what I can do. I actually did this trade already, and I flipped it for a couple $100, and I got back in, and then I just started selling calls because if Intel is going to be a decent trade to buy low, I'm just going to hang on to it. So if I bought shares right now at $21.97, Okay, so I'll write this in the yellow space here. So I can buy shares. Buy shares, so 100 shares at 21.97. Okay. We talked cover calls yesterday. Today, let's talk collar trade. So I'm going to look at a sell call and a buy put. All right. And I want to see if it offers us a credit. Let's do the numbers. So if I look at Intel, buy the shares at 21.97. And let's say I go out to, so we have August 7th is our earnings play. We have 30 days out. I could look at a sell call and a buy put. I could protect my position as we go into earnings. If I wanted to say, you know what, just in case the market goes down through earnings, I might go to the August expiration. Let's talk about here. So if I buy shares at 21.96, okay, I buy shares at 21.96. I'll put 21.97 since I have it written up here on the right-hand side. So we buy shares at 21.97. Now, against that, if I were to sell the $23 call, so I can get an extra $1.19. Now, that means that if price goes up above $23, my break even, 21.97 minus $1.19, I'd own the shares at 20.78. I get it called away at 23. I make $222 on Intel if it goes up over $23. Okay. But if you're worried about prices going down, then you can sell your call at $23 or 20. I mean, 24 is fine too. Give yourself a couple dollars of upside. But what's nice is look at the difference. If I sell the 24 and I buy the 20 or I buy the 19, I can still lower my cost basis by 45 cents and still get the shares called away with price appreciation. So if I did the math on this, I buy the shares at 21.97. I pull in 45 cents credit on a collar trade, which lowers my cost basis to 21.52. I get it called away at 24. I still make $2.48 on 100 shares. So I make $248 of profit on the trade. If price goes down, and as you said, MP, going down to what? Going down to 17. If price goes to $17, this $19 call option, or I'm sorry, $19 put option is going to be worth at least $2. Okay. So if it goes down to 17, I would have $2 of real value in this trade. And right now my debit's only about 45 cents. So realistically, if I have time left in the trade, there's a chance I could turn this, 45 cents into $1.50 to $2, which in turn would still lower my cost basis. Okay, so it needs to be easier to type this out. So if I'll do sell call and buy put. So if I did the 8:15 expiration, so this would be my collar trade, right? So this is my collar trade. If I did the 8:15 expiration, I would sell the 24 call. I'd buy the 19 put. I get 45 cents credit on the trade. So what's my break even? So I buy the shares at 21.97, 21.97 minus the 45 cents credit is going to be 21.52. Break even. Okay. If Intel is greater than 24 by expiration, it's called away. Right? I can still roll it if I want to, but it's called away. If Intel is, let's say, less than 19 by expiration, or 17 in our example, my put is worth $2 or more. If we have some time left in the trade, if we have extrinsic value, if we have time, then we might be able to close it out for $2 plus. But let's just say I get $2 worth of credit on that trade. Okay, so then I can go 21.52. If I close out the put side of the trade minus another $2, that puts my break even at 19.52. What am I going to do with the trade? I know my break even is 19.52. I can then close my call, close my put, lower my cost basis, add another collar trade, protect the downside, try to grab another net credit, protect the downside out another 30 to 60 days, sell a covered call at 20, 21, or 22, still get it called away to repair the stock. That makes sense? So that's if you're worried about the downside, that is the easiest way to play it. I like having the stock called away, and the upside appreciation is great. Obviously, you notice that just selling a call is going to make you more premium, but you don't have any downside protection. So if you want to protect the downside, a collar trade is a great way to do it. You sell a call at a higher price, You buy a put at a lower price, you collect a net credit on it to lower your cost basis, but you have downside protection as well as upside appreciation for a little gain. There's another way to do this, and essentially you finance this thing. And MP says, then keep collaring it. Yeah, correct. If you want to keep collaring, then yes, like you would close out the put, roll down your call, or close out the call because it's going to be mostly in profit. So if I did this trade for 45 cents credit, because of the debit side, if the debit on the put was worth more, I could probably close that put out for like $1.50 to $2 credit, lower my cost basis by another, $1.50 to $2. And then I would say, okay, now if I want to do another collar trade, I sell a 21 call and I buy maybe a 16 put, and I do another 30 to 60 days. I lower my cost basis on the net position. If it gets called away, I can still make my same $200 to $300, maybe a little bit more, and I still have downside protection. Okay. One thing that can be very helpful on some of these collar trades is I don't always want to have to recollar and recollar and recollar, because at some point the stock is probably not going to keep going down. Example being like Tesla. I had shares of Tesla going into the end of the year. I added a collar trade at the end of the year. The long put on that trade helped a ton lowering my cost basis. And obviously when Tesla was down 30 and 40 and 50+%, I wasn't that interested in adding long puts. I was more interested in adding more covered calls and then rolling my covered calls, because I basically protected myself down a big chunk of the downside, and then I started to just take one side of the trade on basically a covered call and just make more money on the covered call. Because it's a big difference. If I lowered my cost basis by $1.20 every 30 to 40 days, that's a big difference between collecting $1.20 or collecting 45 cents. If I'm trying to lower my cost basis, that 45 cents is going to take a lot more time. However, if you're worried about the downside, a collar trade is a great way to do it. Hang on a second. Yeah. Here, I'll just take a screenshot. Let me take a screenshot. Sorry, mine's in the way. Yeah, there you go. Okay, is that better? Let me know if you can see that. So this is just an example. Buy the shares at $21.97. Collar trade is 8/15, so August 15th expiration. You're selling a 24 call. You're buying the 19 put. You're collecting 45 cents on that collar trade. The break even is going to be the $21.97 minus the 45 cents credit. So now my break even on the shares is $21.52. If price rips higher and goes up to $24, $25, $26, it gets called away. Now I can also choose to roll my calls and try to keep generating income. I don't have to let the shares get called away. I can still roll my calls another week or 2 or 3 or 4 and try to grab another 30, 40, 50 cents out of the stock and keep doing that until I don't want to. But the nice thing about the collar trade is you're essentially like, I don't really know what direction it's going to go. If it goes down, give me some protection. If it goes up, let it get called away. Either way, I can probably do pretty well of managing the downside while also give myself an income trade to the upside, right? What you're not going to get on a collar trade is some magnificent stock where it's like, oh my God, the stock jumped up 30%. Look what, if the stock jumps up 30%, your covered call is garbage. You're just going to be instantly in a loss in your covered call. You're still going to net profit on it. I'll still get it called away at $24. That's fine. But that's the cap. It's like you're capping the upside to collect some premium, but you're protecting the downside. So it's just protection. That's really all it is. Okay. So as we said, like you can keep collaring the trade, but if you're at a point, like here's an example on Intel. If Intel had already come down to, let's say, $18, or MP said $17, right? If it came down to $17, would I be that interested in continuing to collar and collar and collar? Probably not, because if I could ride the stock down with a long put and I could lower my cost basis to $19, $18, I might just then focus on only selling covered calls and working my cost basis lower, because I'm going to get a lot more premium by just doing one side of the trade. Because remember, I'm selling a call and I'm buying a put. So one is a credit, one is a debit. That's why it's a lesser net position. That's why when you look at this, if I just did the sell call, okay, the sell call right here is about $1.20 credit. Okay, $1.20 credit. And then the buy 19 put is about a 45-cent debit. Okay. So I guess actually the 24 is it's maybe 90 cents. That's probably, try this. You get it. The difference is I get the credit for the collar. Now, there's another way to do this. Okay. There's another way to consider the collar trade, and it's just, can I finance this for free? Right. So let's say that I do a 23. Okay. And then I finance it with a 21. Look at my credit. I take this collar trade, and I'm not really doing this to make money on the trade. I'm doing this more so to protect the position. If we go from $21.92 up to $23, I'm going to make, so I bought my shares at $21.97, like we said, as an example. I take my $12 credit. My break even's $21.85. I get it called away at 23. So I'd still make $1.15 on the shares, but the downside, I'm just buying a put that's much closer to the current price, right? So I essentially I'm kind of forfeiting the credit side. I'm just trying to say, look, I can get it called away for income, but I'm also buying protection. Because if I didn't do the call side, look, if I just bought a put to protect my shares, I buy shares at $21.97, and then the broker says, hey, if you want to buy a put for protection, you're going to pay $1.07. Now my break even's $23.04. That's a big difference. Now I need the stock to go up to $23.04 for me to make any money in the trade. So that's why I like to pair this oftentimes with the collar trade, because at least I can pull in some credit and I get the stock called away. I can still turn it into an income trade where I'm buying it, creating a little bit of credit to help offset the price. If it goes down, I've got better protection. If it goes up, I get it called away. It's an income trade. That makes sense? So if you're adding covered calls, it's an income trade. If you're adding a collar, it's an income trade. Nobody's adding covered calls to try to capture all the upside. Okay? If you're adding a covered call, it's because you're trying to collect premium and lower your cost basis. And eventually, if you want it to get called away, you've successfully lowered your cost, lowered your cost, lowered your cost, lowered your costs. Make sense? So that's why this week, and I showed this yesterday, this is why we kind of started this conversation. Let's find an example. Let's actually look at some of these top stocks here. And I did a trade today on Micron. Okay, Micron today, I did this during the profit panel. I posted this for my Project Options Edge. And let me see something really quickly here. Project Options Edge, Micron. Let's go here. So MU. The 8250 by 80 was the trade I took today. And then this is a, oops, nope, that's not what I wanted. This one is an out of the money bull call. So going into, this is next summer. If we're up to all-time highs by, later this year, this trade offers up, $1,500 of max credit for a debit of $3. It's $2.80 to make me 15. So I can make around $1,200 on this trade if we're at all-time highs going into next year. The ratio spread that I took today, I put the trade on saying, look, price is at 121. If I go to the options chain on Micron, okay, look at my July option or my January options chain right here. If I go to the 8250 and the 80, these are trading for like a 10 and 9 delta. That means I have about a 90% chance that this remains out of the money by the time I get to expiration. Does that make sense? Is there an option to join the Of course, I've got the Telegram group right here. You can join my Telegram. You can join my Telegram is free. My Discord is free. You can join that, no problem. So here's my Telegram. Okay, there's my Telegram, and then Discord. I'm going to post this Discord link. It's going to be good for 30 minutes. So you can join it now if I post it. So I'm going to go invite people, Discord. This is going to be good for 30 minutes as you're all here live. New link, copy, and then Chris Pulver Trading Discord. Okay, if you jump into my Discord channel, please read the rules. All I'm saying is I don't send friend requests. I don't send direct messages. I don't initiate direct messages. It's me talking to all of you in the public channels. I'm always a public channel person. Telegram is one to many. So, I mean, I don't if you're getting private messages, it's not me, right? Just know that stuff happens. Like I'm out there in the public. So that happens, unfortunately. But anyway, just read the rules of my Discord. It's pretty simple. There's a free group chat. for everybody. Forex, stocks, options, futures. Anytime I go live on YouTube, anytime I post analysis and updates for charts on TradingView, it's all there. Okay. All right. Good stuff. So, all right, let me go back to MU for a second. So here's how the trade starts for me. I'm buying the 8250 put for one contract. I'm selling the 80 put for two contracts. This combination is a debit spread that if 82.50 to $80, if we go down below $80, I get $2.50. So if I just did a debit spread, let me show you this trade. If I just did a debit spread, okay, this cost me 32 cents to make $2.50. Think about that. That's a 780% return on risk. Okay, now it's that way because it's such an out of the money trade. The probability is very low that I'm going to get that payout. The reason I like the ratio spread is because if I have that credit, 82.50 minus 80 is 250. Okay, minus the $80, which is my potential assignment price, because the ratio spread, I still have a put, and that put is $80. That's why it's a 1/2. So I'm still willing to own 100 shares at $80 minus the 250 debit spread and also minus the credit on this trade, which would be $1.75. I got filled in this trade earlier today for $1.69. So I feel like I'm getting ripped off here seeing this at $1.70. But anyway, I took the trade, got filled at $1.69. So if I get assigned on the shares, which here's what has to happen. Micron has to drop 50% for me to get assigned on this stock. Okay. So we'd have to drop to $8. I guess not 50. It's like more like 35, 36%, I think, from current price. But it would be from all-time highs, it'd be down like around 50% from all-time highs. But if I get assigned the stock, that means that Micron is below $80 by expiration. I get assigned to $80. I take away the 50 on the debit spread. I take away the $1.75 on the credit for the ratio spread. I would own shares at 75.75. That's a pretty good discount. That is owning shares at a 50+% discount. I'm okay with that. Okay. Now from there, I would do the same thing to MPS earlier, which is, do I add a covered call? Do I add a collar trade? What am I going to do to turn this ownership position into profit? Does that make sense? I'm looking to hold shares on Micron at 75.75 and hold it back to $150. Because if we came down to $80, I'm just trying to own it cheap and flip it. So if I could sell a call and get $3, $4 and I can get it called away for $3, $4, I take a position that I tie up about $7,500 and I flip it for maybe $500 income. So if I multiply this by 100, I tie up 75.75. Let's say I make $500 on that trade. I can get a 6.6% return in maybe a week or two. Not that difficult. Maybe in 3 weeks, 4 weeks, like a month, whatever. So I can flip the position for income. Make sense? All right, let me see the question here. What if you bought a leap and you're doing a poor man's covered call, then you get called away? What actually happens in practice since you don't own the shares, you hold the leap? You're using the difference between the debits and credits on your long call versus your sell call. So I'll give you an example because I have one running. TLT is one of my and technically, I mean, you buy a leap, you sell against it. That's actually turning it into a diagonal spread. That's what you're talking about. So here's an example. TLT. This is my trade that I'm in live. I bought a 65 call. Okay, I bought a 65 call for January of 2027. So it's a long term expiration. Can we agree with that? So we're trading here at 80 some dollars. I bought a 65, which is pretty expensive. It cost me like $2,400 to take this trade. Okay, so my debit was, let's just say $24. Okay, so what I'm doing is, this is out, let's say, I'm going to ballpark here, about 700 days to expiration. Okay, so what I'm going to do is I'm going to sell calls against this. 65 long call plus the $24 debit puts me at a break even around $89. Everybody agree with that? If I take 69 strike, cost $24, that puts me at a break even price at $89. So what I started doing was sell an 89 call for, let's say, $1.50. Okay. And then this expires for profit. So now my break even goes from $24 down to 20, let's say $22.50. Okay. And then I sell another $89 call for $1. This expires for profit. Now my break even is $21.50. Okay. Now the nice thing is what's my debit? So my debit is $21.50. My break even price is 65 plus 21.50, which now my break even price is 86.50. So I went from making on this trade about $1.50 to now making $3. Or I guess 89, that'd be 89 minus 80, so $2.50. And I do it again, right? So because if I'm going out so far, if I'm going out like 700 days, or I'm going out even a year, every 30 to 45 days, every 30 to 60 days, you can treat this like Muhammad's saying. It's a diagonal spread. You buy the long dated call, you sell the shorter dated call, and you're doing it to lower the cost basis, Okay, so what happens if price is greater than? That was the question. What happens if price, okay, of the underlying asset is greater than the sell strike? Okay, now you want to close the trade. Okay, in my opinion, if you are selling the shorter dated call and now all of a sudden price is above it, I'm more interested in closing the trade. Okay, so if you do nothing, okay, the broker may assign you the sell shares at the sell call strike, which is really going to mess up your trade, right? Because if I'm short a call at 89 and price is greater than 89, and all of a sudden the broker says, hey, this guy's got a sell call at 89, let's assign him 100 shares short. Well, that's annoying because I have a long call that's profitable. So if you do nothing, the broker may assign after expiration, which you're trying to avoid that. Okay. In some cases, depends on the broker. If you do nothing, the broker may pair your sell call with your buy call and close you out for profit, right? So if I lowered my cost basis to 86.50 and I get called away at 89, my long call for 100 shares and my sell call for 100 shares, the broker pairs those together and I make $2.50. And the broker settles that for me and I don't have to do anything. Job is done. Okay. To err on the side of caution, I would do this. I close the position, which means I close the long call plus the sell call for profit. Okay. So what I should be able to close it for, I should be able to close it for the sell call strike price. That's what I should be able to close it for. So if I bought this 65 and I sold the 89 and price is above it, I should be able to sell that position for $89 and change. Okay. And a lot of times that would be the case. So realistically, I spelled that wrong. Realistically, I should be able to close the 65 long call and the 89 sell call for $89 or more credit to close the trade. Okay. And the reason you can typically close more than 89 is because the longer dated call still has some time value, which will allow that to be more profitable. Okay. So if this position in TLT was trading at $90, $90.50, $91, I probably have the ability to close that long call and close the 89 sell call at like 89.20, 89.30, 89.40 credit. And that would give me a little bit extra because of that time premium that's left in the long call. Okay, so this whole story right here, this is a diagonal spread, right? Sometimes it's called the poor man's covered call. So the poor man's covered call because you're buying a long dated call and you're selling a short dated call and you're trying to make it a profit, right? So the reason I call it diagonal is because I'm going out long enough on the diagonal to just buy myself a year or two at a time and then sell against it to turn it for profit. Um, Our poor man's cover call like my favorite strategies? Not really. It's something that you got to go back and revisit quite often. That's one thing that's kind of annoying about it. You got to go back and revisit it a lot. Like every month, every 30, 45, 60 days, whatever your sell call side is, like you got to revisit that trade. I did this on TLT. I've done this on Pfizer. I've done this on MicroStrategy. I've done this on Coin. Like you got to go in and kind of revisit, like, okay, got to monitor my expirations, monitor my positions, so on and so forth. Okay. Do you think there is still a potential for uranium stocks to increase despite the 10? I mean, possibly. I think this whole play on uranium has been a quick price in. Let me come back to TLT in a second. Let me go. I've got stock. So URA is up here at 37. I've got a chart alarm set at 40. I own the shares in the low 20s. I own URA in 20s. So I'm up a decent chunk of profit on URA. I have it uncovered right now. I suppose I could probably cover it like 39 and let it get called away. I don't mind it. But actually I take that back because I don't think I have a full position at 100 plus shares. Let me check my core position here for URA. I think I've got a bunch of like 50s and 55s. Did I close them out already? Oh, I guess I did. I closed it then. So I think I closed it at 39 with a limit. So I'm out of the trade. I would say this on URA. If we pull back to, previous highs here, maybe a pullback towards like 36, 35, 34. If there's anything left in this trade, that's probably the entry, is like get a pullback and try to take that trade. I was fortunate. Like, I was tracking this for the last couple of years. And once I saw like this move and all this consolidation, I started to buy lows. Once we had a breakout, I started to buy lows. So I basically had like chunk one and chunk two, and all of a sudden we're up to the highs. It's been a pretty good trade. Here's symmetry. Here's a fifth wave measured move around $55. I can be greedy and try to keep participating, but I don't know. At this point, when I'm up from $20 to almost $40, I almost turned it into a triple digit winner. I've added to it twice. Anything's possible. It could certainly go up. It could totally go up. But I'm out of the trade. So what I did do instead is, rather than playing the spot price uranium, I'm trading, Oklo and some of the other stocks that are attached to it. Oklo's pulling back, but I put in a ratio spread 32 by 30. I don't mind owning shares of Oklo. I don't think that this stock is a game changer. I just think like it's getting a nod. And honestly, it wouldn't surprise me if there's so many like forced contracts with like Google and Microsoft and Meta. They start doing deals with companies like this. And it's like this company benefits from huge money getting thrown at it to like build out some of the centers or tap it into like natural gas pipelines for some of these AI facilities, right? Or this our data centers, whatever the hell we're building out right now. Make sense? So again, the last thing you're going to see me doing is chasing highs and chasing lows. This market's been up. We've had a big melt up since April. Cool. Like the market's moving. Great. But I don't chase highs. And there's a nice freaking surge to 62.25. Let me check my SPX really quickly. Even my $5 credit's not even filling. I got a 62.25. What the heck, man? That's annoying. I put in a 62.25 by 62.35 trying to get filled at like $5 credit. It's only offering $1.65, $1.70 right now. That's frustrating. Okay, it looks like if you're in the daily profit play for today, that 62.20 is now down about $6. Unfortunately, this market is just like, hey, let's use the last 5 minutes to just freaking go up another 10 points. So that could be the reality. I'll see if this like falls at all the last 5 minutes. But unfortunately, like that 62.20 just wasn't good enough Low of the day, we expected maybe like a 1% move. It's only about 0.6%. So, I mean, the market still has room to run, and this melt up is just no joke. So we'll see what happens these last few minutes. If there's any, red candle here to push this back down towards like 21, maybe it gets that back to 20. Let me move this to 20. I mean, that's a lot to ask for in the next 4 minutes, but one never knows. We'll see how this thing settles. So I'll give you the exact settlement here based on what I see for price on TradingView and my broker platform for Tasty. If it settles at 62.26, that means I'm down $6. If I held the trade, I'm down $6. Right? So I'd be down $6 minus $1.95. I'd be down $4.05 for the day. Okay. But I was out of the trade back in this choppy zone here. I was long directionally. I made profit in this area. And then I was out non-directionally in this first little chop around like 10 o'clock. It was just after, it was like 10, 20, 10:30, closing out for that indecision. Okay, but hang in there. We got a few more minutes. Let's see if the market falls at all. Maybe it does, maybe it doesn't. We'll see. I hope we don't go all the way to 62.30. That would have been the sell. That was the sell call side or the buy call side. So that would obviously like breach the entire spread. But if we are at 26 or 25 or 24, it's a partial loss. And then we have non-farm tomorrow morning. So just another silly little melt up. Can't stop, won't stop. This market doesn't give a funyun. Correct. Yeah, that trade is worth the full $1.10. So if you're still holding that trade, that's worth the full $1.10. So when we did it this morning, okay, this is what we talked about. This trade would have been worth $1.10. Okay. And this trade right now would be down about, we'll say, let's say it closes here. We have what, 2 minutes left? Let's just say it closes at 650. So 650 minus the $1.95 is I'm just going to ballpark it here. So that's 450, 455. So I lose 455 here. I net $1.10 here. So that takes me down to $3.45. So that's my net loss on the day. If I did nothing today for daily profit play, I'd be down $3.45. That's the net. It's not bad. I mean, it's fine. Like you survive, trade tomorrow, it's okay. But what did price do for the day? Got directional, right? And it was a slow and steady directional day, but it proceeded to get all the way through like the 15 deltas, which is annoying for a day's trading. Is getting above the 15 delta, getting above the 20 delta. Like I don't want to see prices push into like this is like a 5 delta this morning. When the price opened, this is like a single digit delta. So it's just annoying. Like that's what prices have been doing. Slow melt ups and 0 DT in a lower volatility environment. It's like, yeah, it can go to the 0 delta for the day. It can get there. And it kind of did. I mean, this was like a 30 to 40 point move to the upside. And the market makers were expecting like a 20-point move today. So that's why your option chain is like, fudge, I'm taking on some heat if I was still on that call side. All right, let's see where this thing settles in the next minute. We're at 3:59, final minute. Closing bell. We'll see where cash settles. Okay, so I'm getting some interesting numbers. I got a 62.27. It was down just a second ago to 62.25. It looks like a 27. 27.41. So that would make a 7.41 minus 1.95 minus 110. 436 on the day would be the loss. So that's the day. Yeah, it is what it is. But again, we managed to trade earlier in the morning. It was directionally running. I grabbed 70 cents out of the directional trade, and I grabbed 40 cents out of the non-directional. So I made $1.10 today. but market was up. It just slowly fed itself all day, nurturing itself on the souls of the bears. Just the most persistent slow melt up all day. And then tomorrow's non-farm. So we'll see if the market cares, does anything. Maybe does, maybe doesn't. We'll find out. Market's coming out at 8:30. That'll give us some pre-market activity. Let's see what the futures market does. We'll see. Okay. All right. For the day, 22K. I'll take it. New highs in the portfolio. I'll take it. I'll say that 320 to 320 and change is my new high for the year. Hopefully a lot more to come. It might be a boring way to get in there, but I will continue just to do my best and grind. So that's it. All right. I will end the charts and questions. So just to recap, we talked simple math. That was yesterday, just doing some covered calls. Today we sprinkled in a collar trade. I pulled this up originally, jobs and earnings tomorrow, and then we have earnings coming out, earrings, with I spelled it totally wrong. Nice job. Let me go to Canva. I'll update that snapshot. Earnings is what I meant. Earnings. There. So let's get rid of this one and spell it correctly. U.S. jobs and earnings on tap. So earnings coming up in a couple weeks. Job numbers tomorrow. Unemployment, average hourly earnings. Is it good? Is it bad? Does the market even care? The market will care about something eventually. All it cares about right now is trying to push as high as it can, as far as it can. Not necessarily as fast as it can. I mean, look, I think that there's going to be a reason. There's going to be a why. There's going to be a pullback. It's just what, why, when, how, who knows. But right now, this is not the time to fade. All you have to look at is what has this market been doing recently. I mean, look at how far back we can go here. This is kind of silly. If you look at a trend line and just go back to the April 7 lows. Just go back to the April 7 lows. Okay? That's clearly too aggressive. But you connect the lows. It's like, okay, support, support. We went sideways. We're back up to it. Could the market get up enough to hit the top side of this and then fall? Sure. Could we adjust the trend line? Yeah, we could adjust the trend line. You can take this and then pull it out there, right? You go a little bit more shallow trend line, you go out there. It's like, if this structure is broken, like, yeah, we could have a pullback, but there's just no reason right now that the market is doing anything other than melting higher. So, like I keep saying, path of least resistance. Okay, Gabriel Walgreens. If they had a dividend, I'd say yes, but they released their dividend. Their dividends are gone. So last time they did dividend here was 25 cents. Dividend here 25 cents. They don't have a dividend anymore. So that the reason I traded Walmart, I still have shares of Walgreens. I meant the reason that I got into this trade was because I wanted a dividend. Right now, there is 0% dividends. It used to be like 5, 6, 7%. Now it's 0. So this makes this way less attractive. I'm looking to see if this is a squeeze in any way, shape, or form. I do have some shares. My break even's like $12. If it gets up to 12, 13, 14, it fills this gap at $15, I'm getting out of the stock. So I'm going to move this up here to a potential gap fill around $15. But I would say realistically, no. Like, this is a pretty terrible stock with no dividend. I don't know what would be a good thing on it. Like, what exactly would be the reason for it to go higher? If I look at WBA fundamentally, maybe. Okay. Insider selling way below estimated value, but I mean, I've seen better snowflake analysis, that is for sure. And I mean, price to sales is next to nothing. Current price versus fair value, it's like, okay, can we get a squeeze in this thing to 15, 16 bucks? If so, like, get me out of the trade. That's about all I would want it to be. I mean, we're talking margins that are like grocery stores. Like, they don't have margins. They don't have profit per se. Granted, like, they've got lots of brick and mortars. They're conveniently located. There's one in almost every area. They've closed some stores where they can also help stabilize the stock. I'm sure they're going to have to do something to turn it around a little bit, but At best, this would be maybe like a cigar butt type style. Like there's nothing really strong fundamentally on it outside of it's, really beat up and maybe there's a squeeze to it. Okay. All right. Anything else? I think I'll wrap it up there for the day. So we just, like I said, recap income trading. We talked covered calls yesterday. We added the collar element today. We talked about the poor man's covered call / diagonal spread today. So just some, good education, trading options. Feel free to ask these questions. I'm happy to talk about them during these sessions. And then earnings is coming up in 2 weeks once we start kicking off earnings with financials. Jobs numbers are coming out tomorrow morning at 8:30. Let's see if there's a reaction. The markets close at 1 p.m. Markets close at 1 p.m. So we've got early trading tomorrow. I'm curious, like not trying to be a hero, but letting the markets do its thing, let it settle, and see if we find a good trade in the morning for daily profit play. Okay. All right. Other than that, I will let you go, and let's come back and do this again. So tomorrow, I'm not going to be live at 3 p.m. since the markets will be closed, and because it's later in the day, it's going to be tough to squeeze in a session live. So what I'll probably do is end up posting a video for tomorrow. So final hour on Thursday will be a little video post, and then Friday, enjoy the holiday, and Friday, Saturday, Sunday, enjoy the long weekend. So all right, I'll see you all tomorrow. Thanks, bye.